Investing, want to start out on previous financial knowledge will help you in the right place, because the one thing we don't teach people is about personal finance. It's considered taboo or to invest, so hopefully you're taking the right steps. My name is Dave and I work in financial service, and the aim of the video is about people to improve financial services, financial knowledge, financial well-being, so you can reach your goals just like me, which may become a net millionaire at the age of 52. So let's get into the latest video. Video is about my stock and shares ISA review for January 2026. Now, it's not to boast or brag or say look at me, but to give people hope. If I can build a portfolio of 6 figures, so can you, if you think long term and invest in a tax wrapper on a regular basis. So what are the aims? Well, annual growth of 10% year on year. We're looking for dividends this year of £6,000 and a year-end portfolio value of around about £215,000. So how have we done the month? Well, we started at 180,645. We finished at 184,051. So in the month, a profit of £3,400. Year to date, up 1.95%. Look at the following graphic. Quick look at contributions. Now we put an amount each month, but it's sporadic. We put in just over £300. So tax year to date, nearly £7,000. Our plot provider charges fees of £22.09, which is based on portfolio management. So as the portfolio increase, our funds will, shall we say, increase. And where are we invested? Well, at the moment, predominantly UK and Europe, nearly 60%. Americas, 31%, and Asia and emerging markets, 9%. Now we are, shall we say, trying to reduce that away from UK into Americas, but we've done it for reasons. Now, in the month, we received no dividends. Say not a good month, but we will have some good results. We will get some dividends, shall we say, in February. Dive into what we've actually held with the portfolio. Well, we'll do our funds first, somewhat simpler. So at the moment, we own 7 funds, 5 in profit, 2 in loss. £94,000, 51% of our portfolio. Now, we've done it for diversification, shall we say, we're solely UK based in individual shares. So we've done it to reduce risk. Now, our largest holding is a Fidelity World Index Fund. £29,000, 60% of our portfolio. Owned around about 1,500 shares, shall we say, or funds. Very low fees of 0.12%, and it has given a return of the last 3 years of over 10%. We just switch off. Now, we own a passive ventures fund through our platform provider AJ Bell. Second holders holding nearly £29,000, 15.5% of them. Done again, just switch off. Numerous companies or sectors across the world, so we say, does what it's set to 10, and again, over 10% over the past few years. Our next fund is somewhat selective, LNG Technology Fund. Now, we've all known about technology the last few months, shall we say, £22,000, 12% of our portfolio, owns about 250 stocks, slightly higher fees of 0.3%, shall we say, but a very good one lately. But and 2 funds that have struggled recently, a Fidelity China Fund. We own nearly £3,000, 1.6% of our portfolio. Had a good run, shall we say, recently, but not in the previous years. And when we get back into profit, showing a small loss, we're going to get out their funds and add it to our existing holdings. 1, shall we say, to simplify, and 2, reduce fees. And we also own a Russia fund. We put £500 in, went to £600 plus, struggled ever since because of the Russia-Ukraine conflict, but thankfully it's only £318, but 0.17% of our portfolio. But it just goes to show you're not going to get everything right, but I'm not prepared to sell at a loss. Now, 2 holdings I've put for a purpose. We've ring-fenced some money for separate our existing holdings. We own an S&P 500 fund. We put £3,000 in. It's now worth 3.8, but 2.6% of our portfolio. And an FT All World Index Fund, £6,700, nearly 4% of our portfolio. Again, it was done for diversification, very low fees, less than 0.07%. But they're my own personal opinions. So apart from, shall we say, our China funds, we see no reason to sell any funds on the foreseeable future, and hopefully the Russia fund comes back into profit. If you like the videos, smash the like button, subscribe to this channel, look at my blog, and let's look at what sort of shares we hold within the portfolio now. At the moment, we own 10 shares, all in profit, none in loss. £90,000, 49% of our portfolio, of which 45% in the FTSE 100 and 4% in the FTSE 250. Mainly, shall we say, what we know, banks, building societies, financial services, but all good companies and we see no sell any shares in the foreseeable future. So our largest holding is Lloyds Banking Group, 21,000 shares, £23,000, 12% of our portfolio. Had a great run lately, very good results, and dividend increased 15%, and it's now on a roll. The shares are well over £1, which have struggled to reach that for the past few years, but a very good company, and a yield between 3 and 4%. We own L&G, the insurance company, 5,600 shares, £15,000, 8% of our portfolio. Hopefully very good results coming up next few weeks, but again, a very nice yield of around about 8-9%. We own Aviva, 2,008 shares, £14,500, 7% of our portfolio. Again, just like L&G, very cash rich, very generative, and a yield around about 6-7%. We own NatWest Banking Group, 1,282 shares, £8,500, 4.6%. The shackles are off, shall we say. It's not owned by the government anymore. Had a great run during 2025, and hopefully results early February will reflect that, and shall we say dividends increased. Again, a yield around about 4-5%. We own Barclays, 1,699 shares, £8,000, 4% of the portfolio, and again, hopefully good results due middle of February. Has got a yield around about 4%. And away from the UK banks, we own HSBC, 561 shares, £7,000, 4% of the portfolio. Again, very good result in the UK. Has struggled, shall we say, China, but it does pay a nice quarterly dividend, and it had a great run recently. Now, away from the banks, we own Phoenix Group, the pension providers, what we know about, 688 shares, £5,100, 2.5% of our portfolio, but a very nice yield of 9%, and it has been on a buying spree lately from consolidation. But will the dividend be retained? But shall we say, it's got good growth plans. We own AJ Bell, or You Invest, shall we say, the platform provider, 991 shares, £4,500, 2.9% of our portfolio. Has struggled lately, but very good results, and it will pay a nice dividend in the start of February, but it's what we see as a growth company. Customers increasing, assets increasing, shall we say, and it's expanding, but it is very cash rich, but it does pay a small dividend. Away from the banks, we own Sainsbury's, 965 shares, £3,000, 1.7% of the portfolio. Very good trading over the Christmas, is doing a restructuring, isn't a price war, but everyone needs food, and it has got a nice yield, as we found out, payable at the end of December. And then finally, we own Card Factory, 4,181 shares, £3,000, 1.5%. Has struggled, shall we say, on the high street, cost of living crisis, shall we say, minimum wage, shall we say, but it is cash rich, it is a growth company, it's still opening new stores, but it does pay dividends, shall we say, and it is, shall we say, expanding. So a collection, shall we say, all UK based, all what we know about, but all long-term companies. We see no reason to sell in the future, but it just goes to show, shall we say, you can get some nice dividends. Across our portfolio, we did receive this month, but we've got a yield of 4.83%. So those dividends will start coming in as the banking results are announced, shall we say, February, March. Remember, it's not a get rich quick scheme. You can get your aims in future if you think long term, invest on a regular basis, and invest in a tax free offer. So if you like videos, smash the like button, subscribe to the channel, look at the blog, and we'll see you again in the next video.